Happy New Year to everybody. It's a great new year. I kind of wanted to start this year fresh. I don't know how the year was for you guys. For us, we ended up positive again this year, although it was definitely an incredibly tough year to trade in BK Forex Advisor and just generally to trade markets because we've had such incredible volatility up and down. But the one really promising and really shining star out of the whole trade that happened last year was all of my short-term trading. And those of you who follow me on Twitter, and by the way, is there anybody who does not follow me on Twitter? Does anybody need to see my Twitter handle in this room? Does everybody know that I am at FX Flow, right? All right, so let's just this is my Twitter handle. It's at FX Flow. Anybody who doesn't follow me should follow me there right away. And anybody who wants to check out, what am I saying? Hold on. I know what's going on. Just bear with me, guys. Bear with me. Okay. All right. And anybody who wants to, find out what it is that Kathy and I do on a day-to-day basis on our advisory service, it's bkforexadvisors.com. You can check out a lot of the stuff on the site for free, and then if you want to subscribe, you can easily subscribe to the website and get a lot of stuff. So one of the things that I kind of really wanted to share with you is that long-term setups or just sort of intermediate-term setups have been unbelievably difficult this year because of the volatility in the market. This is an IntelliChart. This is correct. I use IntelliCharts. I love the software. There are many things about the software that I love. The first and foremost that I really like about the software is that it's incredibly simple to use. It's very, very intuitive. Like, for example, if I want to just highlight a particular area, all I got to do is just go like this, and it just instantaneously highlights the area. But the greatest thing about the software is for anybody who wants to go back on historical data. I mean, going all the way back to 30, 40 years, you can literally go in here, you can go to Advanced Custom and pull up a data like from the euro all the way from the beginning of the euro. Like I think, what is it? Let's go. Blah, 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 blah. You can go all the way back to 96, 95, whatever you want to do. You can pull up data literally on a 5-minute chart. If you wanted to have a 5-minute chart for the last 20 years of the euro, you can do this in IntelliCharts. It's its greatest value, and I absolutely love it. So yeah, that's the chart I use as my personal favorite chart, and that's what I recommend you guys try if you want to high quality charting software. That's nice to see John England already followed me. Anybody else who's in this room should follow me right now at FX Flow to get intraday commentary. We do give alerts on the cell phone in my advisory service, so that's exactly right. That means that we send out alerts instantaneously. More importantly, I send out my alerts are always sent out as a preset. In other words, I'm always entering market on limit, so there's plenty of time to set up your trades and then let the market execute the trades. We're always running into flow. That means we're buying higher, we're selling lower than where the market is at, giving people plenty of time to get into position and then manage the trades essentially automatically. So yeah, it makes it a lot easier. I've basically created the service with that thought in mind. One of the biggest problems I think when you try to follow people's ideas is if they say, "Oh, I'm long euro." Well, how long have you been long euro? When did you enter? What was your price? Was it an hour ago, a half an hour ago, 3 hours ago? It becomes very, very difficult to shadow somebody who doesn't give you plenty of time to set up. That's one of the things that we definitely do in BK. But the key thing I kind of just want to talk about was the difficulty of long-term trading and the success of short-term trading that I've had lately with my flow trades. And I think it brings up a bigger issue as we move into 2012. And I brought up this chart of Eurodollar just as an example of the kind of you could either call it opportunity or unbelievably frustrating annoyance that trading has been. Because I'm just going to show you how the euro traded and how difficult it would have been to make money if you were a longer term trader. So here we are. All right, you know what? I'm gonna lower my BlackBerry before it drives me crazy. All you guys are starting to follow me, which is very nice, but you're triggering all my alerts here. Okay, so here's the euro. This is just last couple of days, and it's just, I think, emblematic of everything that's been going on in the currency market. And one of the reasons why the currency market, people ask me, well, why is it so hard to trade? And let me explain to you, this is the reason why it's so hard to trade. So this is Wednesday into Thursday, right? So Wednesday we consolidate. Euro's very quiet. We all know the big story: sovereign debt problems. We have issues with Italy, issuing debt. Everybody's focusing on all those big issues, right? So Italy then actually issues debt. The issuance of debt in Italy was not very good. It drives the euro down. Then we come into Thursday, and this is where it gets, I think, really fascinating. ECB President Mario Draghi comes out and basically says, "Hey, everything is hunky-dory. It looks to us like the most immediate economic indicators are looking a little bit up. We're going to make LTRO available to the market." And the euro starts to really take off and really starts to have a very powerful move up. Now, if you're a intermediate term trader, what you're seeing here is, hey, broke the recent highs, or broke the recent, sort of the consolidation zone here. It looks like it's a breakout. I want to be a buyer here, and I think maybe the euro is going to have a short covering squeeze all the way down to 130. You certainly have a lot of positioning data on your side. The COT report shows that the euro shorts are pretty much at all-time highs, meaning that everybody who is short the euro is there already. So the potential for a short squeeze is good. The tone out of ECB is much more constructive. They're basically going to make as much liquidity as possible, right? All these things work for you, and on an intermediate term basis, you get long, right? And then comes Friday. And what happens on Friday? What happens on Friday is, we have a crappy Italian auction on the 10-year bond. Basically, what it's showing is that people are more than willing to buy short-term paper using ECB's money, but nobody is willing to go out on a 10-year basis using ECB's money, because everybody is very, very unconvinced that the euro is going to survive that long, or that the value of that 10-year paper is going to be there, right? But that's not even the biggest problem. The biggest problem is that, boom, we get news in the middle of the day that the S&P is going to start downgrading European sovereigns. And indeed, by the end of Friday, they actually do, the downgrade comes through. But the market just basically boom, 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 sells off viciously, breaks all the lows. Now, here's the interesting thing. So the news comes out, we break all the lows, but those people who are trying to sell the lows here get stomped as well, right? Now, what happens here? We basically ran into support here at this 2650, and since there's no more negative news, there isn't much of a follow through in the session today. And if you look at this from a technical point of view, breakups here, breakouts of small SMAs, all sorts of ideas, you're going to get chopped up. You basically get destroyed on a short-term basis. And the reason why, and this is what I continuously try to teach you guys in class, and this is something that nobody ever explains to you, and I think nobody ever makes very clear. And this is why I absolutely do not believe in any technical analysis, because technical analysis tells me very nicely what happened yesterday, but I get paid on trying to figure out what happens tomorrow. And this is the biggest problem. What happens tomorrow can be so diametrically different from what happened yesterday that anything that you were told here is completely and totally useless on a technical analysis basis. So this is why it's so hard to trade what I would call on a swing trading basis within the euro, because from one day to the next, it's like a schizophrenic. It's like dealing with a schizophrenic. The truth today is a lie tomorrow. The lie tomorrow is the truth today. Because what you need to understand, and what I think is very, very important for every retail trader to understand, is that news is not unimportant. News is not useless. That technicals are not the nirvana. News is what is driving the. So Frank is asking a great question. Does this mean that these are better days to do short-term trading? And thank you for basically setting up my premise for what I think 2012 is going to be like. To put it simply, I think there's only two ways to trade this year. You either bet a nickel or you bet 50 cents. And let me explain to you what I mean. What I mean is that this is a sort of a simple way of understanding that you either trade ultra long term, and let's just look at a much longer term trade. Let's even go out weekly, okay? Let's go look Euro weekly for 1 year. Look at the Euro weekly chart. And my point being is that, let's say, you break this 130 level, you either trade on a super, super long-term level where, if you are holding a position, like my friend Ashraf Laidi, for example, is convinced that the euro goes down to like 120 ultimately, right? Well, if you want to make that bet, you literally have to give yourself 500 points. So if I'm short at 130.100, I gotta have my stop at 130.500 in order to have a legitimate chance of a long-term trade working out. Please don't ask me any questions about, other pairs or anything else. Let's just focus on what I'm trying to say, okay? I will ask me questions after I'm done giving up the central point. And the central point is that this applies to every single pair you guys look at. So my point is that you either have a choice of like putting on one trade and maybe holding it for a month or 2 months or 3 months, or maybe even at several weeks, whatever, but with a 500-point stop, a minimum of 500-point stop, because that is the least amount of price action you need in order not to get stopped out continuously. And even then, you probably, if you were to sell this 3,500 here, you would have gotten stopped on the 4,000 here a couple of weeks later, right? It's certainly not a guarantee, but at least it gives you the kind of breathing room you need in order to trade properly. Because trading intraday at 100-point stops is just guaranteed to chomp. Or if you don't want to trade for nickels, then you trade for 50 cents, which is what I've been doing very, very successfully over the last 3 or 4 months. Those of you guys who follow me at BK know that the flow trades have been just killing it. As a matter of fact, last week we killed it, 4 for 4. And let me just show you what we do on the flow trades. I'm going to go to a 30-minute chart for the last 10 days. I like to look at the 50-minute chart, but let's just go to the 30-minute chart. And let me just run through. So what is this? Today is, I think we started the, I think, I'm just gonna take this slice of data and just show you what I do on a short-term basis. And so when you're trading for short-term duration, then the news that's coming out, or the news that's dominating the wires, is the news that you're trading, right? So when you have positive flow, so just to give you an example, on Thursday, we were positive euro on this move over here. We took the 27.50 move up, and it was very, very easy to make 35 points. I basically traded with a 50-point stop on a 35-point target. We made 27.85 within like a couple of hours on a move here, right? Conversely, by the way, the day before we broke the 27.50 here, and we made a move. This was on the negative Italian option, and we made the move over here towards the 2,700 up to the downside. But here's the point: when on Friday morning, I was actually bullish euro pretty much all the way throughout here, thinking that this Mario Draghi situation was going to still resolve to the upside. The short covering was going to kick in. But we also had our shorts at 27. We had two trades, one at 28.50, one at 27.50. This never got triggered because obviously the euro started to move. And then once it broke at 27.50, it just felt like a knife, and we were able to make the money over here in a very nice fashion for yet another trade for the week. So my week this week, by just trading very short-term, trying to follow flow on a short-term basis, was very successful. We had 4 out of 4 trades. That's not a common week. I mean, obviously, you're not going to get 4 out of 4 trades continuously. But the proposition that I'm trying to tell you is that given the market the way it is, that it changes on a day-to-day basis, you either have to look at it on a very long-term basis, on a major sort of a geopolitical long-term trend. Like, for example, right now, if you think the whole situation in the Eurozone will simply not resolve itself, then you got to be short here with like a stop at 135. You got to give yourself that much room to prove yourself over a long period of time if the euro goes down to 120. Or you trade intraday when the news of the moment has the greatest resonance, because trying to anticipate the news from here, what happens here, is almost impossible these days, because this is what, we have change of pace back and forth so much that continuation is just incredibly difficult to achieve. And I think that's probably one of the biggest aspects of 2012. You either trade very short term or you trade very long term, but trading intermediate term is incredibly difficult. And this is true, I'm showing you the chart of Euro, but we can look at the chart of the Aussie, which is different but similar in the same way that you have these big chops up and down. Everybody see the chart of the Aussie here? Right? We have these, for example, we have this big continuation move. You're super bullish, the Aussie, boom. It comes in and gets chopped out, and then now we break all the way to the downside. And it looks like right now, where's the Aussie? Oh, no, actually, and now today, this is another maddening thing, right? Today we're having the Aussie basically break to, here it is. After testing the lows earlier in the session, we're breaking up now up to the upside as we get short covering coming in. So you have this incredible amount of whipsaw action, and you either contain your risk to very short periods of time where, if you're wrong 50 points and you get to regroup very quickly and look for new opportunities, or you give yourself so much room that these kind of wiggles just pass you by. Otherwise, if you're trading on 100, 150 point stops, you basically, getting whipsawed here, I get long here, I get whipsawed, I get short here, I get whipsawed. That's the story of the trade. And the problem is that for every 3 or 4, maybe you're going to get trends once in a while, but for every trend you're going to pick up, you're going to have 4 or 5 stop outs. And clearly, the stop outs are just much more difficult to make up than the 1 or 2 big trend positions that you have. Now, Harley's making a good point. He's saying that huge stops are suicide financially. They are for a lot of different reasons if you don't practice them properly, right? The larger the stop, the smaller the position, right? And obviously, the larger the profit target. You can't have a 500-point stop and a 50-point target. I mean, that's idiotic. You have a 500-point stop. You got to have at least a 500-point target, maybe even a 700-point target to try to even out the books. Generally, you want to try to stay at about 1-to-1, even Steven as much as possible on your positions. One thing I suggest, and this is something that I've suggested over and over again, is it's very important, I think, to segregate your trading, to have lots of different accounts, because one of the biggest problems that most traders run into is they try to practice different trading methodologies in the same account. And you cannot do that. You cannot trade long-term in an account in which you're also scalping. Because what inevitably happens is you either turn your scalp trades into massive long-term trades because you just pull the stops, or you start taking very, very short-term profits on your long-term trades because you're commingling the funds. It is very, very valuable and important to have an account with more than one broker and more than one account with each broker. And generally, what I have is I have my flow trading accounts with one broker, and even there, I segregate it by currency pair. So I have one account that trades nothing but the euro dollar on flow, and it does absolutely nothing else. It trades in the exact same size. I trade at 5-to-1 leverage. That is the most amount of leverage I allow myself. I take very selective trades. I take only trades that I trade. This is an account that I trade side by side with my BK Flow Trades account, and this account is up. Hang on, let me just tell you exactly. So that's 1234. This account is up like 23% levered, 23% levered. So, I put 10,000 into that account. That account has $12,340 now over the last month and a half. And my target is to take that 10,000 hopefully to about, 15 to 17,000 by the end of this year. If I'm super, super great, maybe I'll be able to double the account on a 5-to-1 leverage. But that is all I do in that particular account. Then I have another account where all I try and do is experiment with the flow in the Aussie, and that's basically has been break even because I'm doing a lot of experimentation there. I haven't really solidified my strategy in that. And then I have a third account that is just literally my play account, and I always encourage everybody to have an account whose only function in life, the only function in life of this particular account is for you to stay alive. You're not there to make money. All you're trying to do is just, if you put 5,000 into that account, or you put 10,000 into the account, your only job in life is to take as many trades as possible, but make sure that by the end of the year you're as close to 10,000 or 5,000, your original starting point, as you can be. The idea here is not to win. The idea is to stay alive and to experiment as much as possible with lots of different ideas. It is extraordinarily important to give yourself the freedom, both emotionally and intellectually, to take lots of stupid trades. Great trades come from stupidity. This, I think, is something that most people don't quite understand. That creativity is 90% or 95% or 99% garbage. It's that 1% of a gem of an idea that you can then extract out of your experimental account into your much more substantial larger trading account, and then get to use. And all of you know that I absolutely abhor the idea of using demo accounts, because the easiest thing in the world to do is to become a demo billionaire, and in many ways the most dangerous. So to me, a demo account has only one function and one function only. The demo account's function is for you to learn the ins and outs of the platform. You need to be able to know how to do every single possible trade, every single possible order, every single tweak and peculiarity of that particular platform. That's what a demo account is for. You place about 100 different trades in 100 different stop and go formats just to see how everything works, how well it executes, how well it does. And then once you're very comfortable with the ins and outs of the platform, you trade real money, because there's no substitute for reality. So that's the key thing. Going back to my whole idea of trading long versus short. I think we're in obviously very, very volatile times, and you either expand your stops humongously, or you just trade intraday, depending on what you want to do, and then you give yourself, you focus yourself on one or the other opportunity. Now, those of you who follow me on the euro side, most of you know my euro trade basically is a variant of the run to the OOs. I'm looking to buy the euro or to sell the euro during the prime liquidity hours, which is 4 a.m. New York to about 12 noon New York, which is 1600 to 12 plus 5 is 1700 GMT, right? So let me just put this out here. Now, the only real time to trade is between 4 to 12 New York, or which is like 9 to 17 GMT, I believe. These are the key hours when things happen. Now, things happen, in other times, absolutely, and that's what your experimental account is for, and that's what it's done for. But my whole point is, the one thing I kind of begin to realize as the accounts that are doing very well is that it is much better to pass up an opportunity to make money than it is to make a stupid trade, to chase an opportunity to only lose money. Especially if you're trading like I do with a negative risk reward. I trade with a negative risk reward because you all know that I don't, this whole figment, there are two figments of imagination that everybody teaches you in FX that are complete lies. Lie number one is that technical analysis works, and lie number two is that you must trade with a 2-to-1 risk-reward ratio. In both of those cases, they completely fail you. Mainly because if you trade with the market, simply doesn't give you 2-to-1 risk-reward trades. The market very rarely gives you quality 1-to-1 risk-reward trades. But 2-to-1 will happen 20% of the time. So that means that 80% of the time you're going to lose money, and overall you're going to lose money in the account. So I try to trade as close as possible to 1-to-1. I basically trade 70%. So 70% of my, if I'm risking 100, I want to make 70 cents. That's sort of my sweet spot of where I want to be, and I want to try to be at around 65% accuracy. If I can achieve those, that mix of trades to risk reward, then I'm net positive in the end. Now, the interesting thing, by the way, is that by constraining myself to these very, very high liquidity hours, and this all goes back to the whole idea of like, I always use the analogy of crossing Broadway, because I live right on Broadway in New York City, right? And obviously everybody here jaywalks. New York City is notorious for nobody ever paying attention to red lights, green lights, right? However, and this is a critical thing you need to ask yourself, when is the better time to jaywalk on Broadway? At 3 a.m. at night. This is actually sort of the flip side of it. At 3 a.m. at night when there's virtually no traffic, and I'm walking down the streets because I'm up early in the morning and I can jaywalk, or at 3 p.m. when you have trucks hurtling down the street every 5 seconds. And clearly the answer is that sometimes at 3 p.m. you're going to get like a small window opportunity to cross the street, but your risk of getting hit by a truck is much higher because it's going to come out of the side of your eye and hit you. There's just much more traffic against you. Well, the flip side of that is, when is it better to trade? When is it better to have trending continuation markets? During the better to have life insurance. You're right. Better during the highest liquidity times, when you have the most amount of traders focusing on the single biggest trade in the world, which is the euro dollar. Let's go back to the euro dollar for a second, right? Which is between 4 and 12 New York time, or during Asia when you could have some moves, but obviously you don't have nearly as many traders. So can you make money trading flow in the euro dollar in Asia? Absolutely. But are your chances as great as they are during Europe, New York? Absolutely not. And ultimately, what I'm trying to do is exactly right. People are saying here it's like an insurance company. I am trying to act like an insurance company, like the house in Vegas, like a casino. I am trying to get the edge on my side. My whole point is to trade only when I have the highest probability chance of success on my side. So when I was talking to you about the flow trades, and I was saying, I'm risking 70 points. I'm trying to make 70 points against 100, so 70% of my target, basically, and I want to be 65% accurate. Well, in reality, the reason when you look at my euro account, which is up 23% in the last 2.5 months, and by the way, my GFT account, I was actually able to literally double over the last 4 months trading flow. And the reason why is because by being highly selective, I've actually been at 70% accuracy. I've actually been 5 percentage points higher. That is so massive. You can't, like, on 100 trades, you're going to basically do between 100 to 200 trades a year. So if you can pick up 500 basis points on 100 trades, you have just a massive opportunity to expand your P&L. So trading less makes you more. It's one of those interesting and annoying facts of life, because we all love to trade more, right? Which is why I have my BS experimental account, whose only function is basically to trade more. So, and actually, it's really interesting. I haven't even, as I'm thinking about this, it's the first time I actually thought about this, but what I was thinking about is, how many trades in my experimental account do I make versus how many trades do I make in my hardcore flow account? And I'm not kidding you. I think the ratio is close to 7-to-1. That means for every 7, BS trades that I try in my experimental account, I will only make 1 quality trade in my good account. And that is the difference between winning and losing. And that's the difference between being successful and not successful. So my point is, it is impossible for any of us not to want to make trades, right? I mean, we are here because we love the markets. We love to experiment. We love to figure out what's going on. We love to probe the markets. We love to see what's going on. So we should never stifle our desire, but we should practice it in a safe trade environment, right? Practice safe trading, just like we practice safe sex. Same kind of idea. You put a prophylactic on your account by keeping it segregated in a nice, small size and try to keep it as even to its equity as possible. And only go hardcore, go full force when you have the proper setup on your side. It doesn't mean in any way, shape, or form that you're not going to run into drawdowns, but the whole point is that you will have much less drawdowns and you will have much better accuracy if you restrain yourself from making unnecessary trades. Solomon is asking an interesting question. He's saying, is there a way to identify false moves? Yes, you identify them after they become false, my friend. If there was a way to identify false moves, nobody would ever have to trade for a living. We'd all be billionaires, right? We would just fade every single false breakout and buy every single false, sell-off, and that's all we need to do. We just, sell tops, buy bottoms. Not that easy. You learn by getting stopped out. That's, the way that you identify a false move is by getting stopped out. There's your lesson. And the key thing is, and I'm being a little facetious, obviously, is that what I always try and do is when I'm trying to trade my flow intraday, is I'm always obviously watching the news and watching the price action. And it's very, very important for me to have the price action confirm the news. So if we have positive news, positive price action, then the assumption, and this is basically all it is, it's an assumption, but it's been a very good one, is that positivity, all things being equal, and this is an incredibly big if, all things being equal, the positive news and the positive price action are going to have continuation. Essentially, there are only two bets in the market you can make. You make a bet for continuation, or you can make a bet for risk, aversion. Most everybody in the retail space likes to make a bet for reversion, and that's why they lose money, because it's incredibly difficult to buy tops and sell bottoms. It seems so unnatural, but in fact, continuation, especially on a micro level, on an intraday level, is a much more likely scenario than reversion. And that's why I bet on continuation. My whole strategy, my whole setup is structured on an assumption of the best possible time when I can get continuation within a particular structure, within a particular currency set, within a particular time frame. Have I put enough particulars into it? This is why you understand now why for every 7 trades in my BS account, I only make 1 trade in my real account. Because a lot of particulars have to be met before I want to put on a trade into my account. So this also, I think, Solomon asks, there is an implied question in what Solomon is asking that I think all of us want to ask. And that is this. How much money can I make? Right? I mean, that's all we want. As traders, we're always asking, how much money can I make? And I think that's the critical mistake that most retail traders make, is that they're focusing on how much money they can make. When in fact, how much money you can make is directly, absolutely 100% related to how much money you are willing to lose. Those of you who may have seen my column this week on FX Street or BK Forex Advisors, and let me just, well, anyway, go to the BK Forex Advisors website and just click on where it says Boris, and you'll be able to read the column. I just want you, it's a very, very good column, if I do say so myself. Just go to the front page, and on the side you'll see a Kathy Boris, and you'll see my my weekly column in there. Read it, because the key point I try to make in this column is that the best, the absolute greatest traders in the world follow the following rule: for every 100 points, 1,000 points, 1,000,000 points of profit I make, I expect to give back 50, 500, 500,000. It means for every unit of profit I make, I expect to give back half. If I can just stay at that kind of a tempo, I am one of the greatest traders in the world. This is what Paul Tudor Jones, who's been around for 35 years, pretty much tries to adhere to. He says it doesn't matter whether you trade $1,000 or $1 billion. If you can maintain this kind of consistency, for every dollar of profit, I give back half a dollar of losses, then you are doing very well. So relating to the question of like, how much money can I make? If you are looking to make $10,000 on your $10,000 account, then you must expect, you absolutely have to expect, under the best of circumstances, the absolute greatest scenario in the world, that you will lose $5,000. And I think that's the single biggest problem that most retail traders have, is they are simply unprepared for the idea of losing $5,000 of that $10,000 when they're trying to chase a $10,000 total profit return. If you are mentally unprepared to have that kind of a drawdown, then do not trade. Put your money into treasury bills and make $5 on 200,000, which is what my treasury bills are making right now. And be very happy with literally, I'm not kidding you, $5 on 200,000 for 26 weeks payment. That's what the treasury bills pay you these days. So that's fine if you're just simply not in the right frame of mind to trade. But if you're not willing and expect to lose 5,000 of your 10,000, I'm using 10,000 as just a figure of speech. Obviously, it's 100,000, it's 1,000, whatever you want to use. The point being is you must expect, if you want to double your money, you must expect to lose half. Yeah, if you lost 10K, now Rob was asking a great question. No, Rob, you just lost 10K, my friend. Because, as I said, this is in the best case scenario. This assumes that you have a good edge, that you are trading properly, and that you are using a strategy that actually works. If you are just, BS trading, then you're just going to lose all the 20,000 that you have. And that's fine. And that's part of the education you have as a trader. This piece of advice that I have for you really only relates to successful trading strategies, right? It's not like, if I lost 5 of my 10, I'm now due to make 10,000. No, you're due to nothing. You're due to lose 10,000. The other interesting thing that I think is kind of fascinating to watch, those of you who are in the U.S. may have a chance to have read Barron's this week. And what I found so fascinating about Barron's this week is they have every 6 months they have the round table, and they have the greatest minds in finance. All of these guys who run literally billions upon billions upon billions of dollars in money, right, give their best picks. Well, what was fascinating is when you look at the 2011 picks that all these guys gave and what they did with that number, they couldn't have lost you more money than if they tried. I'm not kidding you. Literally 6 out of 8 losing trades. And the big losers, like each loser 25 to 30%, these were primarily stock ideas. So my point is, and this is literally 6 out of 8 guys produced this kind of a return, where 6 or 7 out of their 8 ideas were massive losers and one was a tiny winner. Like the kind of a record that the worst of a retail trader couldn't even begin to replicate in its horror, right? And only two guys did well. And the reason why 2 guys did well is a very interesting point. Each one of them had very few selections. One of them had only two trade ideas. The other one had only 5 trade ideas. They were highly curated, and they were very well researched. But my point being is that this whole notion that the market is a 50-50 bet is the third lie that people teach you. The market is actually a 75-25% bet against you. That means every time you make a random bet, you have a 75% chance of losing. It's not like a flip of a coin. And the reason why is because the market is skewed to fake you out. You have a whole bunch of very intelligent, very professional, very savvy people whose only function in life is to fool you into taking away your money. So the other reality of the market you need to face up to is that if you think it's just random trading, then 50-50 is not good enough for you to survive. The actual trade odds against you are 75-25, which is why It takes a very long time. It takes a lot of effort to find highly qualified, curated strategies that tend to have a positive edge. And those strategies only tend to have a positive edge in very specific circumstances. So the critical thing that makes it very difficult for us is to wait for those particular circumstances to occur before we take those trades. I think that's pretty much all I got to say for how you start out 2012. So just to repeat my points, either trade very long term or very short term, because I think intermediate term is dead for the time being. Trade multiple accounts and trade your experimental account as many times as you want to try to keep it even, and trade your great account only when the setup sets up. That means time, proper price structure, proper news structure, whatever you like. And even under those circumstances, if you're shooting for 100%, expect to give back 50% sometime during the year as just a partial, natural ebb and flow of how trading works. I think if you can keep those three things in mind, you're going to be very well prepared to trade in 2012. So I'll leave a little time for Q&A. Feel free to post anything you guys like, and we'll spend 5 minutes answering questions. Go ahead. Frank is asking, Teresa is asking, trading hours are 4 a.m. to 12 noon New York time. That's correct. Our SMS service comes with the premium service. That's correct. Everybody gets SMSs from all my flow trades. I do not scale into a position. That is a interesting strategy, but I am a single entry, single exit, fixed odds trader. That means I'm willing to risk a certain amount, I'm willing to gain a certain amount, and I'm hoping to have a positive net percentage at the end of the day. I keep things simple. Scaling into position is a very interesting strategy that I frankly don't have the skills to apply well. If you do, feel free to share with me, and I'll be happy to look at it more carefully. I don't dismiss it. I just simply try to keep my trading as simple as possible. My leverage is on my real account. Is 5 to 1. That is my maximum leverage. Treviso, the liquidity time frame I'm talking about is the actual, is not just the opening, but the whole time frame when you have lots of different people looking at the screens and being able to act. The opening itself tends to be very, very skewed based upon the order flow from Asia, based upon the stops that are resident on there, and based upon a lot of dealer-to-dealer gamesmanship. So I trade. I believe you cannot trade intraday with anything less than a 50-point stop. But at the same time, I think if you trade with anything more than that, you're basically inviting, or you're trying to capture anything more than 50 points of movement, you're basically inviting lots of whipsaw action. Is it harder to achieve a certain percentage return on a large account than on a retail size account? I believe yes. I mean, you always, it's obviously much harder to achieve a 50% return on $10 billion than it is to achieve it on $1 million. That's absolutely true, because one of the great advantages for us as retail traders is that most of us, frankly, I mean, let's say I have a $100,000 account, I'm trading 5 to 1. That's only $500,000 per trade. That means virtually on any given trade, certainly on any trade in the euro or the Aussie, I am not going to get a lot of slippage. I'm not going to be able, I'm not going to get killed. I do get slippage. Don't get me wrong. I'll get at least sometimes as much as 0.7 of a pipette slippage on my execution. But generally, my slippage is never more than a pip. If you have a very, very large, if I'm coming in with a $100 million trade, I could have obviously 5 to 6 pip slippage, and overall, and at the end of the day, that could add up to a very negative edge. So having a small retail account with $1 million notional or less is certainly advantageous. I trade spot, I don't trade futures. Does having an impulsive account not affect my psychological balance? It's quite the opposite. What it does is it allows me to what do you call it? Give off steam. To just lay off steam. I basically it allows me to scratch my itch. A great question. How do I start my morning review? So the first thing I do when I start is I use TweetDeck, and I follow a whole bunch of people. I invite everybody who's follows me on Twitter. If you go to my lists and you see my FX list, that's the key people that my macro FX list. Feel free to basically, copy that list from me and follow everybody on that list. Those are the people I read first, because these are the source of information on Twitter that give me a very, very good, instantaneous wrap up of exactly what happened in Asia. Now, my routine is I wake up at around 2 a.m. New York time, which is around 7 o'clock London, and I look at what Asia's, what Asia has done. What's the story? If there's any overnight macro story, if there's something in the papers that may have hit that could be affecting stuff. What is on the calendar, both economic and political, and also on the auction calendar these days, because obviously we have to watch the auction. My Twitter ID is @FXFlow. Please follow me. I do that for the first 15, 20 minutes just to get a feel flow. I look at all my charts. I look at the euro dollar. I look at the Aussie dollar. I look at dollar yen and pound dollar just to see where things are going. I look at euro Swiss as just a out of the corner of my eye. I don't trade any of the crosses anymore just because I don't have the energy to focus. One of the other things that I kind of found out is that if you're doing short-term trading, you focus. You have to focus. I focus primarily on where the euro and the Aussie are doing, and everything else is just I keep at a corner of my eye. I'll watch the pound. I'll watch the yen as ancillary stories. And then, I'm watching the news flow, the economic flow, anything that breaks on the wires. I watch the Dow Jones news wires, and, I try to formulate an opinion, and then I obviously watching price action. And then as we get closer to the 4 a.m. Time zone, I'm looking to see, where's the price action? I try to imagine what the day could be like, what the potential opportunities could be like in North America, and then we try to set up our trades accordingly. Very often I will hold off. Like if I don't feel that the price action is merited, I will actually hold off. None of my setups are automatic. One of the interesting things that people ask me is, I backtested your strategy. It sucks ass. It doesn't. It's best breaks even at the end of the year. Yeah, if you're a moron robot, you're gonna break even trading my strategy. Absolutely. Be my guest. That's the final lie of FX trading, by the way, is that robots can make you money. Be my guest. Trade MT4 for the rest of your life, and I'll trade proprietary, and we'll see who makes money in the end. Anybody who tells me they have a successful MT4 trading account, just give yourself 24 months before you blow up. I don't believe, because the key thing to trading is context, and that's why every trade is an art as much as it is science. I have a very, very hard scientific structure, but the decision to go or no go is ultimately an artistic decision. It depends on flow, analysis, and other stuff. And sometimes I'm wrong, and sometimes I'm right. But I am right more than I'm wrong in a sense that I stay away from crap more than I take crap, and I miss my opportunities less than I stay away. If you can basically miss less opportunities and stay away from more crappy trades, you're actually doing yourself a huge favor. And that's really the art of the trade. And I think with that tidbit of wisdom, I'll kind of end the program today. And I'll see you guys next week, next month, and we'll pick up the discussion. We'll do some more stuff on how to trade. I hope you guys enjoyed it. Thank you very, very much.